these are the three types of quote unquote traditional types of liquidity. How most of you were probably taught liquidity, but including FEGs, which you probably haven't been taught, but we see relative equal highs as one, we see old highs as another, or relative equal highs and lows as one, old highs and lows as another, and FEGs as a different form of liquidity, okay? Relative equal highs are the simplest one to see. It's two highs that come close together, and then above that is liquidity, right? So anything that looks like some form of support or some form of resistance. The relative equal highs would be two or more highs that are relatively close together. They don't have to be exact. They need to be relatively close together. And then above there, we can expect that there is liquidity, right? So relative equal highs have buy-side liquidity above them. On the flip side, we have relative equal lows. Relative equal lows look like an area of support, and we can expect that below them is sell-side liquidity, and that can be used to fuel buy-side movement. Okay. Now, the second form, and the second easiest to notice here, is old highs and old lows. So a good question to ask here is, how do we know which old highs and which old lows? Is this liquidity? This one liquidity? Is this one liquidity? Is this one liquidity? There's old highs and old lows ever. So what we look for is there's only liquidity above a structural point, a structural high. So that means that it must break structure, okay? So here we have an old high because it comes down and it breaks structure. This could be substructure, it doesn't matter. Break structure, creating a new low, a lower low. Then we know above this high is stop losses or introduction of buyers in some form. So we can smart money can manipulate above this high and then reverse price. If there is no break of structure, example here, did not push below here, this is not a liquid region. This failed to push a new low, meaning there was not enough liquidity here. There's no interest, there's no indication of sellers, a substantial amount of sellers entering the market, and there is no indication that this is some sort of support or resistance to introduce new buyers into the market. You just assume that this is not liquidity. The third and final form of liquidity is FEGs, okay? Notice I have SIBI and I have BISI, okay? This means sell-side imbalance, buy-side inefficiency, and this means buy-side imbalance, sell-side inefficiency. So in a SIBI, or a bearish FEG, which we'll most likely refer to them as, it is an FEG that has an imbalance of sell orders and an inefficiency of buy orders. In other words, it means unsatisfied buy orders. Okay? So if there's unsatisfied buy orders, what do we know about buy-side liquidity? Buy-side liquidity can be used to fill the orders of large players or smart money that has a sell-side bias, okay? So they'll hit these areas of buy-side orders before reversing price to the sell side, okay? Also, the algorithm wants to create, market makers want to create an efficient marketplace. So there are several businesses, countries, individuals that want to do business at this price to buy the currency, and they were not able to, so the algorithm comes back up to satisfy that desire of the market before continuing in its intended direction. On the opposite side, we have BISI, or buy-side imbalance, sell-side inefficiency. That means in this range, buy-side orders were all filled and took control, but there was an excess. Price moved too quickly and did not have time to facilitate the desires of the sellers. So the algorithm pushes price back into here, facilitating the business that needs to be done here in the Forex market. And then it will continue because sell side imbalance means an introduction of sellers here. When there's an introduction of sellers here, we can then expect higher prices. An introduction of buyers here, we can expect lower prices. A quick analogy to explain what imbalance is in the market is we've seen this as an excess or price increasing too quickly, right? So imagine you're a painter, okay? And you have a roller and you dip the roller in the paint bucket and then you want to roll it up the wall. If you roll it up once, you're going to see gaps. You're going to see the old paint underneath. So you have to roll back down and fill it up again. And the more times you do this, the more filled the wall becomes. So imagine FEGs as a wall. Until we come back into it, there are unfulfilled holes. When we come back into it, it is then satisfied. General rule of thumb for FEGs is at a minimum, it takes one tap to balance it, but it can tap in 100 times. It doesn't matter. It is still valid. Okay? So just because it's tapped into once doesn't mean it can't tap into it again and again and again before moving off.